Hello and welcome to Corporate Governance at LSE in a new series on views from emerging markets, where we want to explore issues about governance in other parts of the world. In Hong Kong, we have Hans Hirt. Hans Hirt, as some of you might know, is a fellow of Corporate Governance at LSE, but also director of the Hermes investment fund. Hans, tell us who you got with us today.
Thank you very much, Tom, and welcome from a very hot Hong Kong. I'm very pleased to have with me today two of the leading corporate governance experts in China, Professor Shen from Shanghai Jiaotong University, and Michael Cheng, who's based here in Hong Kong from the Asian Corporate Governance Association. And Michael, maybe I can start with you as my first question on corporate governance. How does China compare to other markets in Asia, both developing markets and developed markets like Japan? I know you have last year published a very interesting study on the topic.
Yes, thanks very much, Hans. Let me show you. This is CG Watch 2014, which is a biannual survey ACGA does with CLSA. China finished ranking number 9, basically at the same score of 45. We mainly looked at 5 areas, and they are CG rules and practices, enforcement, political and regulatory environment, what we call IGAP, which is accounting and auditing, and finally CG culture. We do have CSRC, the China Securities Regulator, making new rules on attendance at AGM and voting, but overall the attendance and also the participation is still rather limited. On enforcement, we get more enforcement initiatives on, say, insider dealing and market manipulation from the CSRC, but we would like to see more consistency and transparency. Now, on political and regulatory environment, I think all eyes are on state-owned enterprise reform, but yet yesterday, I think there was a report by the National Audit Office that, again, over 10 state-owned enterprises, and you're talking about very major SOEs for that matter, having accounting irregularities. And this has been the same theme for the last couple of years. Now, on the fourth area, on accounting and auditing, you have the Ministry of Finance just issuing provisional regulations on basically auditing practices of mainland China companies listed overseas. So we'll see how much progress that will enable accounting and auditing practices to advance for mainland companies. And lastly, on CG culture, I think the general consensus is that you do have a lot of rules and regulations in the mainland system. However, practice is often a different matter. And in a survey conducted by a Beijing University back in 2013, you have over 80% of mainland Asia companies failing that survey. So overall, hence, it's not completely a surprise that China only ranked number 9 out of our 11 markets in Asia.
And what are the key issues? What do we hear from investors before they invest in China? What are the key issues they're looking at?
Financial reporting, I think that's one thing very major, and global investors would not like to see surprises. Hence, improvement in financial reporting is a big theme. And also non-financial reporting is also now becoming increasingly important, with sustainability issues becoming more and more on the agenda. Now, state-owned enterprise reform, I think that's also what global investors would be very interested in. And overall shareholder engagement is another big area. So attendance at AGM, proxy voting. Unfortunately, we have heard anecdotal stories of votes by international investors being rejected. And so we would like to see some progress and improvement on that count.
Let me bring in Professor Shen at this point, and maybe you could just talk a little bit about the corporate governance journey, the history, key developments over the last decade.
In the past decade, I think mainly there have been 2 things the Chinese government has been pushing very hard. One thing is so-called modern enterprise system. By transforming a large number of state-owned enterprises into modern companies and to diverse their ownership shareholding structure. That's one thing. The other thing is amending company law first, then securities law. Now the Chinese government is trying to amend the securities law again. The plan is to have the new securities law amended by the National People's Congress early next year. Certainly there are other moving pieces. For example, the Chinese government has rescued the failing state-owned banks in order to finance, providing stable financing into state-owned enterprises.
And what will be the key aspect of reforming SOE? My understanding is that the government looks more into a system like similar to Singapore, where there is a sovereign wealth fund managing capital rather than managing companies, which is rather different from the current Chinese model.
Whenever we talk about China, there are always two phases. One is international phase, the other is domestic phase. Internationally, we have seen a large number of state-owned enterprises perform quite well through the financial crisis. So China now has 72 state-owned enterprises, which are now global Fortune 500 enterprises right after the United States. But domestically, the portion of state-owned enterprises is declining compared to our private sector. Now China is experiencing the so-called new normal economy, which means there's a slowing economic growth rate, probably less than 7%. So now the government is working on how to bring more private enterprises into the economic growth, economic system. For example, the government now is allowing private enterprises to be part of the banking system. Some privately owned banks are newly launched and set up, Alibaba, for example. So I think state-owned enterprises reform still is on the top of the agenda. The aim is to make it more functioning economically, more profitable, more successful. Together with state-owned enterprises, the Chinese government is also want to see a survival or revival of our private sector.
At this point, I'd like to bring back in Tom.
Obviously, there's lots to do in corporate governance terms in China. And so my big worry in a way is, are things moving fast enough? And the background to it is monetary policy in China was quite aggressive over the last few years. And eventually, even possibly now, this monetary policy is running out and we will move naturally into a time when firms need to be restructured. So the question is, are boards in particular, and governance in general, ready to take on the role of restructuring firms, which might be the necessary consequence following the end of loose monetary policy?
Well, I guess, Tom, the $64 million question is that reform fast enough for global investors? And that could be a very subjective matter. And it also depends on the methodology and also the culture and mindset of different global investors. Now, one way to look at it, obviously, there has been tremendous progress in, for example, state-owned enterprise reform in the last few years, since the third plenum of November 2013. However, is or would sort of the reform coming out of that initiative be of a sufficient pace for global investors when the markets have been, the domestic China market has moved, as we have seen, with a bit of a roller coaster ride for a lot of investors. And talking about boards in particular, in fact, we've had the rule that 1/3 of China boards to comprise of independent directors since 2001. And that is like some 10 years before Hong Kong finally got that rule into place in the listing rule. Yet, however, how much would these independent directors function effectively at boards of listed companies in China? That's a different question. So again, it's all relative. And again, I sort of repeat my overall observation, is the pace fast enough for you?
I have always Japan in mind. Japan had very loose monetary policy, then ran into trouble, and only now is coming around in restructuring its governance codes and really trying to attract foreign money. But I think you're right that compared to Japan, China is probably well ahead of everybody. You mentioned the boards, and the boards of state-owned companies and the boards of private companies. Are they really comparable? Are private companies take it serious, or are they appointing friends and family?
So on some level, private enterprises in China have kind of prospered despite or irrespective of governance standards. However, we have spoken to and visited some private enterprises in China, and we do find some refreshing observations that a lot of those family-owned private enterprises in China are appointing independent directors to be sort of a teacher or a professor of sort of the second generation of that business, which to us is actually a good trend. Now, as for state-owned enterprises, I think we are all on the same page that it quite depends on the role played by the regulator SASAC, the State-Owned Assets Supervision and Administration Commission. Now, the recent trend, I think SASAC is very keen to point out to the market that they would like to reduce their regulation more to one of management of capital and try to bring down their level of direct influence or regulation in the SOEs. But that process would take a while.
The major problem with the private sector is the difficulty in financing. They have a huge difficulty in mobilizing financing from the state-owned banking system. That's why we see a huge shadow banking sector in China. At the same time, the state-owned sector or state-owned enterprises are not economically efficient. For example, they can have probably 60% of the financing from the banking system, but they can only contribute probably 20 to 30% to the economic growth. And by contrast, the private enterprises can only get 20% out of the banking system, but they contribute probably 60%. But the problem with the state-owned sector is the strong support by the government in terms of its political system. When the public sector is not successful or the economic is slowing down, then the government will rely on the private sector. But at the same time, or later on when the economic situation is better, then the government probably will switch back to the state-owned sector and trying not to be that supportive to the private sector. So there's always some uncertainty there.
Do you think in the whole corporate governance system of Chinese companies, is there a role for investors, like we're seeing all across the world, starting in the United Kingdom, this codes, stewardship codes for institutional investors, encouraging institutional investors to take more of a role in the corporate governance of companies? Do you think this is something that is valid and useful and possible with state-owned enterprises in China?
My feeling is China overall is a hybrid regime in terms of its corporate system, corporate governance system. On one hand, China is moving towards rights protection, shareholder rights protection by bringing some concepts from common law jurisdictions, for example, derivative actions, so on and so forth. On the other hand, China is moving towards so-called corporate social responsibility and other civil law traditions or concepts. Corporate social responsibility is brought into Chinese corporate law from European system. But again, when you go back to the rights protection, when you go back to the corporate social responsibility, employees or stakeholders have no mechanism to enforce their rights. So overall, in terms of enforcement, in terms of effect or efficacy of these concepts, it relies on the China's overall economic scenario.
Michael, any views on role of investors? Also, we have heard the legal perspective. Anything without litigation, perhaps?
Yes, well, in fact, Hans, today is a very momentous day of the signing of the agreement for the establishment formally of the AIIB, the Asian Infrastructure Investment Bank. Now, if I may say, that's part and parcel of China's very progressive One Belt, One Road policy initiative, and also its sort of going out policy. Now, obviously, this kind of go both ways. China would always welcome the sort of participation by global investors. So the more participation that global investors, whether through QFII or RQFII, and now mutual connectivity through, for example, Shanghai Hong Kong Stock Connect, although the percentage perhaps in the Asia domestic market may not be very significant right now, but this trend will potentially be very influential and significant.
Let us come back to Stock Connect and the recent share price movements, but maybe asking Tom if he has any questions on what we've just heard on the role of investors in particular.
I follow with great interest this debate about enforcement, because I think it is a very important dimension of governance here, that you have the backstop of going to court, or you have the right to call an extraordinary general meeting with a small fraction of shareholder votes. And I will be quite interested to hear more about it, because as Hans rightly pointed out, litigation is not a way going forward, but maybe there are other enforcement mechanisms we could employ to substitute for the lack of litigation or court efficiency.
In securities regulation or securities law, basically there are two types of enforcement. One is public enforcement, the other is private enforcement. Public enforcement relies on a regulator, how regulator plays the game in the marketplace. In that regard, I think overall, probably CSRC, which is the equivalent authority of SEC in China, is probably doing not that successfully so far, because in the capital markets in China, we still see a lot of scandals and market manipulations, so on and so forth. So in that regard, public enforcement probably is not that successful. The reason probably is related to the limited availability of administrative resources. Overall, in CSRC, we only have 400 staff, so there's a mismatch in terms of administrative resources and the size of capital markets. Then we move to the the second type of enforcement, that's private enforcement. Then we rely on the courts, rely on the investors to see whether investors can initiate some litigation. But again, in the past decade, we only saw one or two cases in which minority shareholders brought lawsuits against directors. So some scholars look at the third type of enforcement. It's called semi-enforcement system, which relies on reputational sections or shaming sections. But again, if public enforcement is not successful, then probably very unlikely reputational enforcement is not functioning well as well. The overall trend is a decline of using these reputational sections. So I think the problem with China or Chinese capital markets, again, is about its enforcement system.
Then let's talk a little bit about Stock Connect, which everyone talks about here in Hong Kong, and at present, at least the people I have met the last couple of days. Michael, just explain us very briefly what Stock Connect is and what the implications have been recently.
Yes, and in very simple terms, Stock Connect allow the investors on both sides, investors in the mainland, to be able to transact Hong Kong stocks, and then Hong Kong stocks or Hong Kong investors via or global investors via Hong Kong Stock Exchange can then transact in mainland domestic stocks. Shanghai Hong Kong Stock Connect brings a totally different dimension to the challenges on enforcement. What if you have a Hong Kong investor not happy with, for example, a mainland listed company? So can that Hong Kong investor start litigation in Hong Kong or in the mainland? And vice versa, what if mainland investors are unhappy about a Hong Kong listed company. So how will a mainland investor via private enforcement or otherwise try to enforce their rights in Hong Kong? What about the regulators on both sides? The two regulators have entered into a memorandum of understanding, but we have not seen a concrete case yet in these 6-7 months of a real case of enforcement. And the share price movements have been dramatic, to say the least. So with these kind of dramatic movements, potential violation of securities laws and potential litigation will happen. But how will that all take place is right now, I think everyone's very interested in.
My understanding is there are many more retail shareholders involved in investment in Shanghai. How much does that play a role in these dramatic share price ups and downs we have seen here in Hong Kong?
You have something like maybe I think there has been studies that in the mainland China market you have something like 90 million to 100 million retail investors, and that's a lot, very significant segment of the market for the regulators to be concerned about. Now Hong Kong obviously it's a much smaller market from a retail investment point of view, but I think recently the Hong Kong Stock Exchange has done a survey, and you have basically something like 30 to 40% of the adult population in Hong Kong also investing in shares. So this sort of amount of retail investment in the securities market is not something to be taken lightly.
Tom, do you have questions on this part of our interview?
Not on this one, but there's one question that I will be very interested in hearing more about is remuneration. Remuneration is kind of an integral part of governance, at least the way we know it. Setting the right incentives, schemes and structures, which is quite difficult to get right actually. How much is it actually used as a governance mechanism? And if it is used, is the pay disparity as large as it is here between the top and the bottom?
I think relatively, in our survey of 11 markets in Asia, remuneration is relatively not of a priority as much as in sort of global concerns on that issue. And if you have a market like China, very often you have the reverse side of concern, which is remuneration more set by the state regulator. So overall, how effective or how significant is a vote against a director's pay? I think it's relatively of a different concern in the Asian markets as compared to other global markets. That would be my 2 cents on that issue.
In China, executive pay overall is not a huge problem because the government does not use executive pay as a corporate governance instrument. Instead, the government uses the executive pay as a political instrument to condemn corruption and other politics-related scandals. So the central government has a cut-off policy saying all the executives in large state-owned enterprises can only have annual salaries at the rate of 600,000 renminbi per year. So you have 2 options if you are top executives in state-owned enterprises. You can stay and take this salary, annual salary, or you can leave and the government can offer you a better job. And most executives are willing to stay, and they like to take a pay cut. So the reason for that is probably there are other compensation for the salary loss, for the loss of salaries. So executive pay in China is not calculated based on the performance, company performance.
Something I learned relatively recently is about variable interest entities and their role in particular. I think it was an issue when Alibaba had the listing. Can you just explain very, very briefly what variable interest entities are and their significance and legal uncertainties around their existence in China?
VIE is a transactional structure in which Chinese investors bring overseas or foreign investors into some restricted sectors, such as telecoms sectors. These sectors, according to Chinese law, are not 100% opened up to foreign investors. So by having this VI structure in place, foreign investors can invest into a holding company of SPV in overseas jurisdiction like Hong Kong, Cayman, or BVI. Then this holding company will invest further into a Chinese entity. So in the marketplace, a lot of telecoms enterprises in China are using VIE structures widely in order to attract foreign investors into their businesses. So we see Alibaba, Tencent, Baidu, Sohu, all of them basically are using these VIE structures. The regulators are trying not to allow Chinese investors to use VI structure in order to attract foreign investors. But the Ministry of Commerce is trying to amend its foreign investment law. The VIE, the legality or validity of VIE will be formally endorsed to bring back Chinese entities which are listed overseas, like Alibaba, Tencent, because all of them are very good enterprises. They have good assets. So the Chinese government doesn't want to see the flow of good assets out of China. So the rationale is to bring them back.
Michael, do investors, foreign investors you speak to, do they understand the current legal situation around these entities, and are they aware of the risk and the uncertainties?
Yes, Hans, I think a lot of global investors are very concerned about the potential change in legislation or rules for the VIEs in the sense that right now they already have exposure to certain listed companies, for example, listed in the US and some listed on the Hong Kong Stock Exchange, which have adopted a VIE structure. Now, in the consultation that Professor Shen has talked about by MOFCOM, there is some chapter and verse as to how potentially the existing listed VIEs can be dealt with, but that is not entirely clear. So I think a lot of global investors and the market are very interested to see what potentially will happen to these existing and listed VIEs. But I think to date, a lot of global investors are still trying to come to grips with how exactly they need to deal with VIEs from a legal and or regulatory risk point of view.
Tom, do you have any follow-up questions on that topic?
I'm not a lawyer, so I leave the law questions obviously to the lawyers. But I'm very of time, we're running out of time soon, and I just wanted to ask our guests to quickly summarize their main points of governance in China, the main issues of governance in China today, and how they see it going forward.
First of all, improve the general meeting and voting regime so that international investors can participate more. That's one thing. And the second thing may be connected with the first one. Please provide more materials available in English. Because right now, I think perhaps substantial information on the CSRC website and the exchange's website are only available in Chinese. And last but not least, as I think we've covered quite a bit in this discussion, state-owned enterprise reform. I think global investors are very interested to see how state-owned enterprise reform will unfold.
My angle probably is quite academic. I think the first thing is about ownership diversification. So this is related to state-owned enterprise reform. It's very important. So I think how to move forward, probably we can rely on overseas listing so that all these state-owned enterprises can continue to piggyback on common law or other better corporate law, corporate governance regime for corporate governance reform. So that's one possibility. The other thing is about rule of law or court system, how to make a court system more functioning in China in order to protect shareholders, in order to protect investors in capital markets. The third one is about how to offer better rights protection to foreign investment community, how to make foreign investment or foreign investors more functioning, more effectively in Chinese corporate law, corporate governance reform.
I have one last question. I mean, we have seen this extraordinary share rally in Shanghai over recent months, and also some quite significant decline in the last week. In particular, what's driving the Shanghai market in particular?
Probably to quote the most well-known economist in China, Professor Hu Jinglian's comments, he said Chinese capital markets is a casino, basically. So probably that's the best way to rationalize the current development.
I'm not an economist or a financial expert, I'm a governance advocate. So from my perspective, I would urge our global investors to be very careful about their investments and to use their own methodology and parameters to make sense of the current rally and declines and what have you, and approach their investments from a long-term perspective.
Professor Chen, Mr. Cheng, thank you very much indeed, and back to Tom in London.
Many thanks, Hans. All that remains to be said from my side is thank you very much to our guests in Hong Kong, to Hans, and of course many thanks to you for watching us today.